Thanks, Emily. For today's presentation, I'm going to be, excuse me, leading us through, and Melody's going to be monitoring the Q&A in the chat, and she'll let me know if anybody has any questions that are directly related to what we're going over. Format for today is that we plan to go through the actual loan forgiveness application. So we're going to walk through the different worksheets and schedules and some of the nuances that we learned about and came through the forgiveness application. And we made this presentation a little bit longer than our past ones to ensure that we can try to address as many questions as possible while we're on the call today. But like Emily said, we will be sure that if you have a question that didn't get answered, make sure you submit it in the, excuse me, the Q&A. And get back to you after the presentation today. So with that, we'll go ahead and dive in. Like our other presentations, we want to just make sure that we have this planner. We want to make sure that everybody understands that information continues to be clarified and is subject to change. I'm going to talk a little bit more to that in just a second, but we just want to make sure that everybody understands that we aren't providing legal advice. And we are just offering general ideas and considerations, knowing that every organization and business's situation is different. We are using the most recent guidance to guide you through our presentation today. So it is up to date as of this morning. But as we've seen throughout the course of the last 2 months, we get new information almost, excuse me, almost on a daily basis. So we just want to make sure that everybody is keeping that in mind, that even the things that we go through today are still subject to change. With that, I do just want to make note of an item that came out just this morning. So as I mentioned, we are giving you guidance up to date as of right now. We do want to let you know that there is a bill in the works. It is about to go to the House, which is the first level that it has to pass. And it is an act that is strictly related to the PPP program. It's called the Paycheck Protection Program Flexibility Act, and it's not intended to give more money to the program. It's simply intended to make the use of the funds and the forgiveness more flexible. There are a lot of questions that came in before today's presentation about not being open over the course of these 8 weeks, or not being able to be open until after June 30th. The idea that there are people that you can't rehire because there isn't any work for them to do. So this act would include the potential to maybe extend forgiveness allowance beyond that 8-week period. Potentially changing the limitation that keeps you at 25% overhead costs. There is also potential to extend the rehiring deadline. So right now, June 30th is kind of our end-all be-all date for this program, and there's potential that that may be extended. Again, I just want to remind everybody, excuse me, that this could change tomorrow. This could change next week. This could change in a month. This is an act that has not passed yet. So we are giving you guidance, again, that is in place and fully formed as of today. But we just wanted to make sure that everybody knew that this is a possibility and this could be coming down the pipe. So, we want to stress that the loan forgiveness application, it's not due right now. It's not even due when your 8-week period is up, because you are going to need to look at that June 30th period end date. So at this point, there shouldn't be any rush to get this loan forgiveness application in. You're going to want to continue to be in constant contact with your banker or your lender, and you're going to want to continue to keep an eye on guidance from the SBA, because they're going to be the ones that dictate when you have to have this application in by. And the hope would be that we have absolute final guidance before June 30th. This way, if anything does change, you have a period of time to be able to adjust to those changes. So again, we're going to go through the forgiveness application as it stands right now in its form that it's in, but know that things can change, and they likely will change. So we're going to, continue to push out information to you as it changes. But for right now, we want to give everybody some confidence in looking at the application, If you want to start playing with the application to figure out, as it stands right now, what your forgiveness is going to look like, that's what we're going to help you with today. We're also going to talk about some of the guidance that was clarified with the loan forgiveness, and then answer any questions that were submitted beforehand or during the course of this program. So with that, forgive me for my allergy coughing. We will jump right into the application. So I'm gonna switch back and forth a little bit between our PowerPoint presentation, which as a reminder will be sent out to you, excuse me, after our presentation today. And I'm also gonna be switching back and forth between the application itself so that you can see what the application looks like along with what we're telling you are the rules and the application instructions. So in the loan forgiveness application, there are a number of different documents. It's an 11-page document and it contains a few different things. There is the loan forgiveness application itself, which includes certifications and instructions. There's a Schedule A and the instructions for that Schedule A. Then there's a worksheet for Schedule A and the instructions that go along with that. And then there are a list of documents to submit with the application, and then demographic information form, which is optional. They're requesting that you fill out that demographic information so that they can collect a little more data about who applied for the loan, who's getting forgiveness, etc. But it is an optional form, so it's not something you're going to be required to fill out, that demographic information. One thing I do want to stress before we dive into the form, as I know there were a few questions that were submitted beforehand about this, this loan forgiveness application is required for everybody. So this is not just for those that received a loan less than $2 million. This loan forgiveness application is going to be required for every single person that received a PPP loan. It is not guaranteed that 100% of your loan will be forgiven, even if you received under that $2 million. The $2 million that number came about because there were questions about the certification on the SBA application itself, about whether your organization or business really needed to apply for this loan. You had to certify that there was enough economic uncertainty, that there was going to be some sort of negative economic impact on your business. I would say 98 to 100% of all people that applied for this loan easily made that certification. On April 3rd, nobody had any idea what was going to happen with their business. So whether you haven't seen a lot of impact, you've seen a large detrimental impact, or maybe you've seen sales grow, the realization is that you made that certification in good faith when you applied for the loan because you didn't know what was going to happen. So the SBA and the Treasury put out information that let people know that if you received less than $2 million, you were automatically assumed to have made that certification in good faith. Now, I want to stress that that does not necessarily mean that you won't be audited in the future or questioned or asked to provide more documentation. I think it's imperative for everybody that took this loan out to make sure that you continue to keep incredibly detailed documentation. You have memos in place for why you applied for the funds. More documentation is better than less in this scenario. So just because you received under $2 million does not mean that you won't necessarily be audited in the future. And it does not mean that you don't have to prepare this forgiveness application. Those requirements are in place for everybody. So one of the things that we're going to talk a little bit about as it relates to this application, I'm going to pull up the application here. If you haven't seen it, this is the first page of the application. Like I said, it's 11 pages long. Most of that is words, instructions. As with many tax forms, we can tell you that they are often somewhat backwards. So you'll notice that a lot of the information that you're required to enter, I'm going to scroll down here just so you can see a lot of instructions. I'm going to scroll down to the actual loan forgiveness calculation form. And what you're going to see here is that the very first item in the actual forgiveness amount calculation is coming from another schedule. So the way that we're going to kind of walk through the application itself is we're kind of going to take it backwards. You pretty much have to start with the worksheet to get to your Schedule A, and your Schedule A information is going to filter into the forgiveness amount calculation, the first real page of data information on your sheet. So that's how we're going to think about the application today. We're going to kind of work backwards. So with that, I'm going to go ahead and go back to our PowerPoint so we can talk about a few important details as it relates to the application itself. So a lot of information came out about this covered period. This covered period has been obviously a hot topic because there wasn't really a lot of clarity on what the 8-week period could be, should be, shouldn't be. So what the application did actually was it really did clarify what this 8-week period meant. There were a lot of questions about cash basis versus accrual basis. There are words like incurred and paid. And so all of that was leading to a pretty substantial amount of confusion, understandably. So one thing that was luckily clarified in this application is what this covered period means. Essentially what it is it's defining a 56-day period that your payroll costs can cover. So the covered period can be one of two different periods. It's 8 weeks, regardless of which one you choose, but it can be two different ones. So the first period you can choose is the 8-week period starting on the day that the loan is dispersed into your account. So you may have applied for the loan on April 3rd, maybe approved on April 5th, and you actually got the money in your bank account on April 10th. April 10th is the first day of the initial of your 8-week covered period if you choose to go with that option. 8 weeks goes from if you got the money on a Friday, the 8-week period ends 8 weeks on a Thursday. So just keep that in mind. It's not a Friday to Friday. It's not a Wednesday to Wednesday. It's exactly 56 days. So that's what your 8-week covered period is. What they did give you the option of is to use an alternative payroll covered period. So to be able to opt into the alternative payroll covered period, you have to have a payroll frequency of biweekly or less. So typically that's going to be biweekly or weekly payrolls. If you have a semi-monthly or a monthly payroll, you cannot opt into the alternative payroll covered period. So that's important to know. The alternative payroll covered period is an option for you to choose, again, if you're a biweekly or a weekly payroll frequency payer. And that payroll period then can begin on the first day of the first pay period after receiving the loan funds. So if you received your PPP funds, I'm just going to pull up a calendar here real quick and walk through it. Let's say you received your PPP funds on Thursday, April 30th, and you have a payroll dated May 1st. The payment came out of your bank account on April 30th, and it's paid to your employees on May 1st. You can opt to have your 8-week period start on Thursday, April 30th. And because you have a payroll that came out of your bank account on April 30th to be paid on May 1st, you can start that day, and that payroll is included. The alternative payroll covered period is going to be a little bit different. So if you have a payroll that's dated May 1st and you're a biweekly payer, let's say that May 1st payroll is actually for the pay period April, it would be April 12th through April 25th. So your pay period is April 12th through April 25th with a pay date of May 1st. You can make a decision that you want to choose the alternative payroll covered period. So now we want to ensure that our period begins on the first day of the first pay period after receiving the loans, which is another mouthful. So let's explain what that is. If you have 2-week payroll periods, so we've just identified our April 12th through April 25th is paid on May 1st. Then we have April 26th through May 9th, which is then paid on May 15th. So that payroll would not be included. You would start it on the first day of the first pay period after receiving the loan funds. which means that if you received the funds on April 30th, your pay period that starts after receiving the loan funds is actually going to be May 10th. So I realized I just threw a lot of dates out at people, but it's important to note that you can actually shift the pay period somewhat substantially. In this example, it's now 10 days after the date that you received the loan. So you've bought yourself an additional 10 days of time to put that 8-week period out. So something to think about and something to play with a little bit if you've just received your funds, or if you received your funds before and were hesitant to be transferring money or actually paying funds out of those accounts. You now have this alternative payroll covered period that you can play with a little bit to ensure that you're starting rehiring people back, as late in the process as you can. So something to think about, but it's not as easy as it sounds, because you have to be thinking about the period beginning on the first day of the first pay period after receiving the loan funds. So now we're going to go ahead, like I said, we're going to work backwards on this loan application. So we're going to start with the actual worksheet itself. There are 2 tables, and I'm going to pull the worksheet back up here. So we're going to go ahead and go to the worksheet. Again, we have instructions, and then we actually have the worksheet itself. So here we go. Here's our Schedule A worksheet. So you'll notice that there are 2 tables on this worksheet. We've got the table 1, which includes employees that made less than or equal to $100,000 for all pay periods in 2019. So their annual salary was less than $100,000 in 2019. That's what table 1 is for. Table 2 here is for any employees that made more than $100,000 in 2019. So we want to just make sure that you understand that there are two different tables for each employee. Now, the worksheet itself is likely not something you're going to have to submit to the lender. They may request it as backup documentation, but it's not a required form that needs to be submitted. But again, it's going to be up to your lender what they want as the backup documentation. But you are going to need to fill this out to be able to do all of the calculations in the application itself. So table 1 and table 2, we want to be sure that you've got all of the information ready to go. You're going to need payroll reports from your payroll processor. So if you have, if you work with an outsourced payroll processor, many of our clients work with HR Aware, Paychex, ADP. There are, all different payroll processors. You're going to want to be in touch with them because you're going to need to request some specialized reports for them for certain periods of time. So it's going to be important, again, that you're not only in touch with your lender, you're in touch with your accountant, you're also in touch with your payroll processor. If you process payroll in-house, you're just going to need to know that you're going to have to pull some payroll reports based on customized dates as it relates to the information that we're going to have to pull. I'm going to go back here. So in the worksheet, we did just want to emphasize again that table 2 applies to any employees that are receiving more than $100,000 for any pay period. So that means if they got a raise, let's say in November of 2019, they were making less than $100,000 prior to that. They got a raise in November 2019, and their annualized salary is now over $100,000. They would be listed in table 2. So it doesn't matter if they actually made $100,000 or more than $100,000 in 2019. It matters if their annualized salary at any point in the year was over $100,000. So we've shown you kind of an example here of what those numbers look like if you're on a biweekly table or a biweekly payroll, excuse me. So in addition, on the Schedule A worksheet, there's a box called cash compensation. What that cash compensation includes is gross salary, gross wages, gross tips, and gross commissions. So essentially any amounts that you paid to your employees. That's what's going to be included in the cash compensation. The one item that you cannot include, it is not eligible as a payroll cost under the PPP program, is paid wages paid under the Families First Coronavirus Response Act. So if you are paying the emergency sick leave or the emergency family paid leave under FFCRA, so there are very specific reasons why you would be required to pay somebody under FFCRA. They're all related to COVID-19 or healthcare. Those wages you pay for, but you get credits, dollar for dollar credits for paying those wages. So because you're getting credits for paying those wages, you cannot use the PPP funds to cover those wages. So we want to make sure if you are paying anybody for those types of wages, again, if you're outsourcing your payroll, you're going to make sure that there's a different pay code set up for those people, which your payroll processor should have done for you already. If you're processing your own payroll, you want to make sure that you have a brand new payroll item set up for that payroll category, because it is a different, you don't want to include it in regular salary or hourly salary or PTO, regular PTO, because you are going to need to break those wages out so that you can claim the credit, and also so that you can reduce your PPP calculations. We're also noting here that cash compensation cannot exceed $15,385 for any employee. What that number is coming from is essentially it's taking a $100,000 salary, dividing it by the 52 weeks in a year, and multiplying it times 8. So essentially what this is doing is annualizing anybody's salary to a maximum of $100,000, and that's what the PPP funds can cover. So you can pay employees more than their $100,000 annualized salary in a year. The PPP funds just cannot cover more than up to $100,000. So just want to make sure, I know we've seen a lot of questions about that. Can you pay people over $100,000? Yes, you can. Do you have to include, can you use the PPP funds to cover any of those wages? Absolutely. You can use it up to that annualized $100,000 per pay period. But not in excess. So just want to make sure that everybody understands that. You can continue to pay those people. The PPP funds only just cover a certain amount. Another one of the hot topics that has been on everybody's mind over the last few months is this FTE. So FTE stands for full-time equivalent. And that's one of the ways that your loan forgiveness can be reduced. So on the worksheet, there is also an average full-time equivalent calculation that you're going to need to do. It's going to be calculated either for the covered period, or if you chose the alternative payroll covered period, you're going to have to calculate the average FTEs. That is calculated as an average hours paid per week divided by 40. There was some potential guidance that the one full-time equivalent may be anybody that works 30 hours or more. This has been clarified in the loan forgiveness application that came out, that it is going to be based on a 40-hour work week. So I want to stress that again. It is not 30 hours. That is one full-time equivalent. A person has to work 40 hours or more to be the equivalent of one full-time employee. So anybody that works less than an average of 40 hours per week is going to be less than one full-time equivalent employee. So in the example here, if somebody works an average of 30 hours per week, they are going to be considered a 0.8 FTE. There is an alternative or simplified method that you can use to assign FTEs to your employees if you don't want to go through the hassle of calculating. Let's say you have 200 employees and most of them either work 20 or 40 hours a week. What you can do is you can use the simplified method, and anybody that works 40 hours or more per week is considered one FTE. A person cannot be more than one FTE. So if somebody works an average of 60 hours a week, they are still considered 1 FTE. They're not 1.5. It doesn't go above 1. So anybody that works for 40 hours or more is considered 1 FTE. And again, if you want to go with the simplified method, anybody that works 40 hours or less, you can consider 0.5. So that's going to make it a lot easier for you to do calculations. However, if you have had to shift hours or reduce hours, it may be to your benefit to go back and calculate the actual, use the actual calculation where you're taking the average hours paid per week and dividing by 40, because it may have a significant impact on your loan forgiveness if you choose to go with the simplified method and you have people that were working maybe 30 or 35 hours a week and now they're only working maybe 15 or 20 hours a week. It is going to have, it could potentially have a difference. Or if you had people that were working 40 hours a week and have now gone down to half time, or if you've just maybe cut 10 hours here and there, you're going to want to think about doing the actual calculation. But there's a lot of math involved, that there's no doubt about that. The other piece of the worksheet is a salary or hourly wage reduction. So what we knew already before this forgiveness application came out was that the intent was to have kind of a layered approach to figuring out the forgiveness. That first step is, did you use at least 75% of the money for actual eligible payroll costs and only up to 25% for overhead costs? The second is going to be that FTE calculation. And then the third is the salary or hourly wage reduction calculation. So again, if we think back to the purpose of and the intent of the Paycheck Protection Program, it was essentially for businesses and organizations to be able to retain or rehire their workforce. So the idea was that if you had to lay people off, you would be able to rehire them, even if you didn't necessarily have work for them to do. Part of the idea was to lessen the strain on unemployment. Obviously, we've seen unemployment numbers that we've never seen before. So, the hope was that especially if benefits were being offered, like healthcare or retirement benefits, that an employee would much rather keep those benefits and stay on as an employee versus leaving the job or, having to quit or being furloughed or being laid off and having to collect unemployment where those benefits, they don't get those benefits anymore. So that really was the true intent of the Paycheck Protection Program, was to allow businesses to be able to use this money to fund a payroll, even if they didn't have a job for somebody to do. So I want to remind everybody that even though that feels wrong in some instances, paying somebody to sit at home, that was the true intent of this program. I think some of the potential changes to the program will make it easier for business owners, organization leaders to feel comfortable using that money in that way. But I think, that we have to go back to what the true intent of the program was. So,
hey, can I jump in on wage? Because we're getting a number of questions on what's included in that wage amount. Can you address the issue of unemployment compensation and bonuses or hazard pay at this point?
Absolutely. So at this point, what I will say is that guidance has neither clarified nor eliminated the option for paying hazard pay, some call it hero pay, or paying bonuses. So hazard pay is kind of a pay premium that has been another hot topic recently. And it typically relates to paying, you may have seen in the news, Amazon, I think Starbucks, they're paying their employees an extra $2 or $3 an hour. And it's called hazard pay because they are deemed essential employees, and it's a way to keep their employees coming to work. It's kind of, a benefit for them having to come in and do their job while the pandemic is happening. I would say confidently, and this is in line with what we have been saying throughout the course of these webinars, I think hazard pay or, you know, a bump up in salary in this period is going to be completely legitimate, and you're going to be able to cover that using the PPP funds. Bonuses are still a little bit of a question mark. I think, again, with the clarified guidance that this is truly to cover a 56-day payroll period, there would be questions around whether or not you typically pay bonuses in this period of time. If you're just paying out bonuses to be able to use all of the money, I think you're likely to put yourself in a position where there are more questions that may be asked. You know, ultimately, if you don't hire back all of your employees, so going back to the FTE calculation, if you don't end up with an FTE number that's the same or greater than the FTE number on the comparative periods, which is either going to be the first 2 months of this year or a period from last year, even if you paid the people you retained more but didn't rehire all of your people, you're still going to have a reduction in your loan forgiveness. So it's not so much about being able to use all of the funds as it is about making sure that you've hired all of the people that were working for you in February back on. So bonuses, if you are a commission-based business, you work on commission, you're gonna probably wanna look to what the average commission was for the same time period in a prior year and pay your employees, even if they aren't making sales. You can likely justify that paying them the commission that they likely would have made based on their numbers last year. You can pay them that this year. Same goes for restaurants and tips. That's been a question that we've seen a lot. Ideally, you're going to have to look at those comparable periods and determine what on average your employees typically made, including tips. For restaurants, the regular, just their regular hourly wage is going to be less than minimum wage. Sometimes it's a couple dollars, sometimes it's more, but they're really making their money in tips. So you're going to have to figure out what a comparable hourly wage for those people is, based on not just their base hourly wage, but also what their average tips are. So again, it comes back to math. There's a lot of math involved in all of this. But right now, hazard pay, hero pay, if you bump up people's salary a little bit over this time period and it's reasonable, I think that you aren't going to have an issue. The bonuses are a bit of a question mark. If you typically pay bonuses on a monthly basis, I would say you're gonna probably not have any issue using the PPP funds to cover that. If you usually only pay a bonus at year end, I think that's gonna be a harder sell to be able to include that bonus in that 8-week covered period just to be able to use the funds. So again, guidance not 100% clear on this. But like I said, the guidance also didn't say you can't use it for that. So we're giving you our best interpretation of the information that's available. Any other questions, Melody, before I?
Unemployment compensation. It's come up a couple of times. Unemployment compensation is not included here, correct?
Unemployment is not. So if you have employees that were laid off and they are now collecting unemployment, they cannot continue to collect unemployment if you are paying them a wage. So that's important to note. I do think that there are, now I'm not an expert on unemployment by any means. I do know that you can collect unemployment to an extent if you are normally a part-time employee, but that's part of the unemployment application. My understanding is that, if you are collecting unemployment based on not working X number of hours and now you are being paid for those hours, you can't be collecting unemployment and also being paid by your employer. So that's something that you want to be aware of. If an employee is collecting unemployment and you offer them a job, we're going to talk a little bit more about this in a bit, but there are some safe harbors that were put in place for anybody that you offered a job, back to come back, you make a written offer to them to come back, and they say no, they don't want to come back. Maybe they're making more money on unemployment with the additional federal unemployment right now, and they tell you they don't want to come back. If you have documented that, again, written documentation that you made an offer to them and they declined it, there are going to be, you're not going to get dinged by that in the forgiveness application. So that is another positive aspect of the guidance that came out. There are some safe harbors. There are some safe harbors that will allow you to, if you fired somebody for cause, if somebody retired or they quit, there are some safe harbors in place so that that's not docking you when you go to do your FTE calculation. Did that answer the question, Melody?
I believe so.
Okay. All right. Okay, so we're going to forge ahead a little bit talking about the salary and hourly wage reduction. Again, I want to stress, I stressed this at the beginning, but right now we're walking through some of the new guidance and the application itself. But as a reminder, nobody's going to be able to actually complete this application and submit it for at least another 6 or 7 weeks. June 30th is a big date right now. June 30th is the last day you can apply for the loan. June 30th is the last date that you're going to have to look at your FTEs or whether you've restored your pay back to its February pre-pandemic pay rate. So June 30th is kind of this buzz date. So realistically, you're not going to be able to actually finish and complete this application, but we understand that a lot of people are itching to understand the possible calculation better. So that's what we're walking through here. So the salary and hourly wage reduction is only applicable for employees whose salaries or hourly wage were reduced by more than 25% during the covered period. So if you did not do any payroll cuts or salary cuts at all, then you do not have to worry about the salary and hourly wage reduction portion of the worksheet. So if you kept everybody as is, or if you did a 10% salary reduction across the board, or even a 20% salary reduction across the board, you don't have to do this calculation. It's only if you cut salaries or an hourly rate by more than 25%. So just want to stress that. You don't have to do this calculation unless you knowingly cut somebody's annual salary or hourly wage by more than 25% during this covered period, as compared to the period January 1st through March 31st. So if that is applicable, there are additional steps to follow in doing a calculation. So with that, I'm going to, again, show you what some of this math actually looks like. So I know this is probably a little bit small for some people on your screen, so I apologize, but I just want to make sure that people have an idea of what is going to go into these calculations. So what I have on the screen here is kind of a sample pulled into Excel, a sample payroll report. So we just have some miscellaneous names and numbers in here, but this is showing what salary looks like. So PTO is included. So again, if you paid somebody for vacation, or if a holiday pay fell over the course of your 8-week covered period, which for many it may with Memorial Day, or if you get your funds later, July 4th may fall. If you pay somebody just for normal sick time, so somebody's just out with a migraine, or they're out with a sickness that is non-COVID related, and you're not paying them under FFCRA, that is eligible wages. Vacation, so all of that is eligible, whether they're salaried or hourly. Expense reimbursements are not included, so also wanted to stress that. So if you pay somebody a monthly office supplies stipend, that is not an eligible cost at all. So just make sure you're noting that. What is included are the gross wages. So when we look at salary, this is before any deductions that the employee has comes out. So this salary here, so we're looking at about $40,000 between salary, PTO, and hourly wages. That is our eligible cost. So that includes federal withholding, state withholding, and the employee share of FICA, Social Security, and Medicare. It also includes the employee's share of contributions to their retirement plan. It includes the employee contribution, it includes the employee contributions to their health insurance plans, as well as their retirement plans. It also includes if there are alimony payments or child support payments. The gross salary is everything before deductions. So it's not the net pay, it's the gross pay. That is what's eligible. In addition, the retirement contributions that the employer makes, those are eligible costs. The employer contributions to the health insurance are also eligible costs, and any employer paid state and local taxes. So for most people that are on the phone, that's likely going to be the state unemployment. There are some jurisdictions that have local taxes that are paid at the employer level as well. So those are all eligible payroll costs. In addition, I've also included here on this schedule, I've included a note about payments to owner. So if you are the owner of a business, maybe you're a partner in a partnership, or maybe you are you report your income and expenses on a Schedule C on your 1040. And you don't get a W-2, so you don't get a paycheck, but maybe you get guaranteed payments, or you pay yourself as you have money. Many Schedule C owners, you take money out of the business as you're able to. So for Schedule C businesses, you are able to pay yourself the equivalent of 8 of 52 weeks worth of your 2019 net profit. So if you didn't make a net profit in 2019 as a Schedule C business, but you had employees, you were able to apply for the loan to cover your employees' payroll costs, but you were not able to include any amount for yourself. If you were a Schedule C business and you had a net loss in 2019 and no employees, you were not eligible for the PPP loan at all. But if you were an owner with employees that had a net profit, you were actually able to include not only the payroll costs to your employees that receive a paycheck, you were also able to include a calculation for payments to yourself, which essentially, again, was the equivalent of 8 of 52 weeks worth of your net profit in 2019. So here I made a note that the owner's net profit on their Schedule C was $20,000. So the calculation then is $20,000 divided by 52 weeks in a year, not 56. 52 weeks in a year times 8. So this is 8 of 52 weeks worth of your 2019 net profit. So with the PPP funds, you are able to pay yourself $3,076.92. So again, that's your Schedule C net profit divided by the number of weeks in a year, 52, times 8, which is our covered period, 56 days. So that's what you're able to pay yourself. Payments to owners, payments to partners are not included in your Schedule A worksheet. So you are not included on this Schedule A here at all. You are going to have to list the payments to yourselves, but you don't include yourself anywhere in the Schedule A worksheet or in the top portions of Schedule A, so in the cash compensation. The Schedule A, there is a section here that says compensation to owners, and that's where you're going to enter the amount that you paid yourself. And again, it's based on that calculation that you are paying yourself 8 of 52 weeks worth of your 2019 self-employment income or net profit on your Schedule C. And it does say this amount may not be included in the Schedule A worksheet. So I know that that was we had a couple questions that came in beforehand about that as well.
Hey, what's coming up in the questions related to that right now is what if the owner though gets a W-2? You still exclude them from the worksheet?
Nope, if they get a W-2, they should still be included in the worksheet. So that owners to compensation compensation to owners section is just for those owners that don't actually get a paycheck or W-2. So that's a great question. So if you are an owner of a business, I know we have a lot of co-ops on the phone call too, because I know we had some questions before. If you are a member owner, you're an employee, you get a W-2, you should include yourself in these worksheet calculations. So once you've completed your Schedule A worksheet, which again talks about the FTE calculations and the salary and wage reduction, which I think, yeah. So once you get through those calculations, you get to Schedule A, which is then going to start helping you calculate the numbers that are going to appear on the main form. So I'm going to go ahead and go back to this spreadsheet here. So we talked a little bit about what information you're going to need to filter into your loan forgiveness calculation. And then here, I laid out a little bit, and I think what we're going to plan to do is we're going to send you this example as part of the packet that we send out with the recording and the PowerPoint. This way you have a chance to kind of look through the numbers and get a better understanding, because we know that this is a lot of math. Even for myself and Melody, I mean, we spent a lot of time just putting an example together because the math it's involved, a lot of steps going back and referencing. So we want to make sure that you've got an example to look at if you do want to be playing around with this. So the example that I have here, I did include a salary reduction that went into place on 4/1, but there was no FTE reduction. So in this example that I'm showing you here, the FTEs remained the same, but there was a salary reduction that took place. So you'll notice here, this table actually pretty much matches up through the salary and hourly wage reduction. It pretty much matches what our worksheet looks like here. So I made it match this first table. And we don't have any employees that make over $100,000 in this example, but we've calculated the average FTEs for each of these employees by counting up the number of hours that they work. Then we have the FTE calculation for the covered period, and I decided to use the calculation as opposed to the simplified method. So we did a calculation where we divided the average FTEs by 40 hours. And then again, anybody that's over 40 hours is still 1. And then we start calculating what their average annual salary is for the pay period. You also have to calculate what their average annual salary or hourly wage was for the first 3 months of the year. And then there's a calculation, and the application does walk you through the math and walk you through step by step what to do. But again, this example may be helpful. And then we calculate a wage reduction percentage. So anybody that's under 75%, we have to factor in the amount of their wage reduction that's going to reduce our loan forgiveness. So you'll see here, I've got 2 people that slipped a little bit below that 75%. So then we have to do a safe harbor calculation. So we talked a lot about safe harbors. Safe harbors are put in place to hopefully help you kind of meet some exceptions that would allow you to take some maybe full deductions or get more forgiveness as opposed to having your forgiveness reduced more. So what the safe harbor calculation does is that it looks at, so we have 2 employees that we have to do this extended calculation on. So all of these other employees that didn't have a wage reduction more than 75%, we don't have to do anything with them. They're fine, they're good to go. We don't have to think about them anymore in terms of the wage reduction calculation. But for the 2 employees that did, we then have to follow the next steps. So you have to look at their annual salary at the pay period 215. You're also going to look at their average annual salary for this alternative payroll period, I'll call it. It's kind of a payroll period that will likely span a period of time where you may have included reductions. So it's going to lower the average annual salary in most cases for you. So in this example, I have the salary cut going into place on April 1st. So we take a look at our average annual salary for that period. And then we're also going to look at our average annual salary at 6/30/2020. Again, that's kind of our buzz date. So for this particular instance, we didn't increase salaries back by 6/30. Then you take 75% of your average first 3 months wages, and then you're going to calculate a salary deduction that's essentially going to take your average salary from the 1/1 to 3/31 pay period minus the 75% of your 1/1 through 3/31 wages. And you're going to get a number that gives you that salary reduction. This number here it's not going to turn into a percentage. You are going to have an actual dollar for dollar reduction of your loan forgiveness based on the amount of wage reduction that you calculate as part of this worksheet. So where the FTE calculation, you'll see a reduction based on a percentage of your reduction in full-time equivalents. For the salary and wage reduction, it's actually going to be a dollar for dollar reduction in your loan forgiveness. So there are a couple different things that you have to be thinking about. So, we didn't want to dive into the math too heavy because there is a lot of math. And again, you're not going to need to do these calculations for a while. And there is a likelihood that things are going to change. But we wanted to at least be able to provide you with examples so that if you do want to start digging into the math and the actual application itself to calculate what your forgiveness may look like at this point, we wanted you to have the ability to do that. So on Schedule A, you're going to end up taking a number of lines. So this is Schedule A. So the first half of this schedule comes from the worksheet, which makes sense. But again, it's we're working backwards. So we started with the worksheet that's at the bottom of the application. Then we moved to Schedule A, where you're actually putting in the cash compensation, your average FTEs, so all of the numbers that you came up with on the worksheet, which is going to be figuring out that salary reduction, figuring out your average FTEs, and entering in your cash compensation. Table 2 is again that the amounts for employees that made over $100,000 at any point in time in 2019. Then you're going to factor in your non-cash, they're calling it non-cash compensation payroll. So that means the employer contributions to health insurance, retirement plans, and then those employer paid state and local taxes. Those are all the other eligible payroll costs that are included. Your compensation to owners, which we talked a little bit about, that's typically going to be your average, your 8 of 52 weeks worth of your 2019 Schedule C net profit. If you're a partner in a partnership, you may have included your guaranteed payments, or from your K1, your self-employment income, again, taking 8 of 52 weeks. If you don't take guaranteed payments as a partner, you'd be looking at your self-employment income that you receive on your K1 and taking 8 of 52 weeks worth of that based on your 2019 return. And then you're gonna add up your total payroll costs, and you're going to do your FTE reduction calculation. And again, if you have not reduced the number of employees or the average paid hours, you don't have to do that calculation. You just enter 1. And then you get to move into the actual loan portion, the forgiveness portion of the application itself. So Schedule A, we talked a little bit about, so line 11, which if we go back to line 11 is the average FTE during the borrower's chosen reference period. So the chosen reference period is going to be either the first 2 months of this year or the period 2/15 through 6/30/19 of last year. If you're a seasonal employer, there is a different 12-week pay period that you can elect if you choose to do so. With seasonal employers, they may not ramp up until closer to the summer, so there are some alternate reference periods that you can choose from. But again, that's only if you're a seasonal employer. Let's see. So for the FTE calculations, again, you're going to want to think about how much math you're going to have to do before you dive into them. So there are essentially about 5 or 6 different periods that you're going to have to calculate the FTEs for. So this is where you're going to want to think, do you want to use the simplified method? Did you not have that much change in how much your employees are working? If so, you can use the simplified method, or if you didn't have any change at all, again, you don't have to worry about these calculations. If you did have a substantial change, obviously restaurant, hospitality industries likely had substantial changes in their workforce. You're likely going to want to put the time in to do the math for each of these periods to figure out which one is most advantageous. So there is the 8-week covered period, or the alternative payroll covered period, which again, each of them is 8 weeks. So you've just got your 8-week covered period. Then you have your selected reference period that you would either choose between 2/15/19 through 6/30/19, or the first 2 months of the year. So you choose between those 2 time periods. But again, you're likely going to have to you're going to want to do the calculation for both of those periods to figure out which one is most advantageous. Then if you are a seasonal employer, you can choose any 12-week consecutive period between May 1st and September 15th, if that's more advantageous for you. You also have to look at the payroll period that includes 2/15/20 if you're looking at that safe harbor rule. You also need to look at the period 2/15 through 4/26. That's to figure out if you meet the safe harbor rules. And you also have to look at 6/30/20. So if I'm looking at this, I'm looking at 1, 2, 3, 4, 5, actually 6 time periods that you'll likely want to calculate your FTE calculations, which is not necessarily an easy burden to bear if you have 200 employees and they're all hourly. If you're a restaurant and you have, tens or hundreds of employees, this is going to be a little bit of work. So again, make sure you're talking to your payroll provider, you're talking to your accountant. We certainly will be able to help our clients with these calculations. So know that we're here if you have questions. But again, you aren't going to have to do this until this forgiveness application is due, which is not going to be until at least June 30th, if not a little bit later. But these are all the things that you need to be thinking about. And again, FTE calculations are based on a 40-hour work week. 40 hours, not 30, 40 hours. So some of this reduction relief I talked a little bit about before. This was not something that we had clear guidance on. So this was great news that we got more clear guidance on the FTE reduction relief. So we talked a little bit about what happens if an employee declines your business's good faith written offer to rehire them. Like I mentioned in the example, there are going to be a number of cases where somebody may actually be making more money collecting unemployment. Now, is that going to work out for them in the long run? Who knows? But if you did make a good faith, again, written offer to rehire them and they declined it, you want to document that it was declined. Likely have it written, but that's not going to impact your FTE calculation. So you're going to have some relief there. If you have an employee that was terminated for cause, again, documentation in those situations is always important, but I would say even more so in this period to justify that you terminated somebody for cause and that's going to help you when you're doing your FTE calculation. Or if you have an employee that voluntarily resigns, or if they voluntarily request to receive a reduction of hours. So we had a lot of situations where employees suddenly became teachers and they were having to be home and taking care of their kids. So now they've voluntarily requested a reduction in the number of hours. That is not going to negatively impact your FTE reduction. So just make sure that you're keeping great documentation of these things. Make sure that everything is written. You have notes and memos and written documentation for all of these things that are happening, because it will positively impact the amount of forgiveness that you're going to see. We talked again a little bit about the safe harbor. This is going to be, again, calculating your FTE numbers through all of these different periods of time. So if the organization reduced its FTE employee levels in the period beginning February 15th and ending April 26th, and the organization restored its FTE employee levels by no later than June 30th to the levels that they were at as of February 15th, you're going to, again, meet a safe harbor that's going to help reduce the amount or that's going to limit the reduction in your loan forgiveness. So a lot of dates to remember and a lot of numbers to calculate, but these are all in place to help you get the maximum amount of loan forgiveness. So you don't want to miss any of these by not having documentation, by not doing the calculations. It's going to take a little bit of work, but ultimately I would think most businesses want to have the maximum loan forgiveness. So on the loan application itself, so now we're finally to the actual loan application, kind of where we started, going back to where we started. So the loan application has a lot of the information that you had to put on your original application for the loan: business name, address, your EIN, if you have a DBA or trade name, contact information. You're going to make sure you have all your documentation from your loan that you received, your loan number, your lender loan number, the total amount that you received, the disbursement date, and this employees at time of loan application and employees at time of forgiveness application. I want to be sure that people understand, I don't believe, and Melody, you can correct me if I'm wrong here, but I relate this to exactly like it was on the original application itself. This is strictly looking for head count, not FTE. What the SBA, I believe, is tracking, so to be able to apply for SBA loans, you have to be a small employer, which means you have 500 employees or less. So I believe that the SBA is using this to track head count, not full-time equivalent. Melody, do you have a different feeling or understanding about that?
No, I agree. But one of the questions that's come up is, what if at time of application I did not submit the correct head count? Now what?
So the head count that you submitted on the original application, again, only was on the application for the SBA to make the determination that you were a small business and eligible for the loan. So if you had 600 employees and you wrote that you only had 400, you're going to have a problem because you weren't actually eligible for the loan. If you had 10 employees when you applied for the loan and you only wrote 8, that doesn't matter. That doesn't factor in at all to the amount of loan that you got in the first place, because that was based on your 2019 payroll. And it also doesn't have any impact on the FTE calculations that you have to do as part of the worksheet and the Schedule A. So these two lines here, employees at time of loan application and employees at time of forgiveness application, have nothing to do with the FTE and really don't essentially have anything to do with your application. If the numbers are different, so this employees at time of loan application, if you put 10 here and on your loan application you put 8, be prepared to likely answer a question, but I don't see how this would have any impact on your loan itself, because the loan amount that you received had nothing to do with the number of employees. That number that you put on the actual original application was strictly a head count number. So how many employees in total, part-time, seasonal, full-time, how many employees do you have? There was no FTE calculation that needed to be done. So that hopefully that answers questions. I know we had a couple before, and I think that should answer those questions. You do have to put if you received the EIDL advance amount. So you may have applied for and received the EIDL advance. So that was the up to $10,000 grant. You do have to list that amount here. I will note that in this application itself, if you've had a chance to look at it, you'll note that nowhere on this section of the application does it have you reduce your loan or forgiveness amount by the amount of the EIDL loan. what it does say in the application, and I'm going to find it here so that we can. Just want to make sure that we find it. Here we go. So this is line 11, which is basically the final line on the first page of the forgiveness application. That's calculating the forgivable amount. It does say in the instructions that if applicable, SBA will deduct the EIDL advance amounts from the forgiveness amount remitted to the lender. Now, does that does that clarify for sure if it will be reduced by that amount? I don't think it does. There were some questions. What if we use the EIDL advance for something different than the PPP funds? I don't think that's going to matter. I think they're going to reduce your forgivable amount of the PPP by the amount of the advance that you got. However, I just wanted to point out that it's really not clear in this forgiveness application how that's going to factor in. All it says is, if applicable, the SBA will deduct the advance amounts from the forgiveness amount. So I would plan that if you got $10,000 and you think and you got if you got $10,000 EIDL grant and you received $75,000 in the PPP loan, and you used all of it towards payroll and you think it's all going to be forgiven, the likelihood is that 10,000 of it is not going to be forgiven because you got that EIDL advance. So I just wanted to point that out as well. So if you did get notification, the EIDL application number, you'll need to include that. And then we walk through what is included on the loan application itself. So your payroll costs, and then lines 2 through 4 are your non-payroll costs. For mortgage interest and rent, they did clarify that it is mortgage interest and rent on real property and personal property. So it's not just rent for office space or your restaurant space. It also means if you rent equipment, those costs are included, or if you have a loan out for any personal property, capital lease, and you're paying interest, that interest is also covered in addition to mortgage on a building interest. If you have related parties, so you own a business and then you, in a separate business, a separate partnership or LLC, you own the building as well. So essentially you're paying rent to yourself. That is eligible as long as you're making those rent payments, you're paying them. You have to have a rent agreement in place, and it had to be in place before February 15th of this year. But as long as you have that documentation in place that you had a rent agreement between the two parties, even if it's a related party, those are eligible costs. So lines 5 through 7 on the application go back to the FTE and the salary wage reduction calculations that we talked about. And then lines 8 through 10 are the potential forgiveness. So that's where you're calculating the reductions from the FTE and salary and wage reductions, your total loan amount, or the maximum loan amount you reported for payroll costs being 75% of the forgiveness. So I'll go back to the application here so you can see that we're looking at a lesser of, so potential forgiveness amounts. And again, even on here, it tells you potential forgiveness amounts because if you did receive that grant, it's likely going to be reduced. Or if somebody checks your math, which it is possible that somebody would do that and would let you know that one of these numbers needed to change, you're looking at 3 different numbers here, either your total loan amount, your payroll cost, 75% being your payroll cost, or whatever you actually spent that was eligible, you're going to choose the lesser of. So if you received $65,000 and you used $55,000 on payroll costs and you didn't need it for anything else and you didn't have any other reductions, you are going to have $10,000 left. That is going to be a loan. And in that scenario, you have the option to pay it back right away. If you didn't need it and you're still sitting on it, there are no prepayment penalties, so you can pay that right back. Otherwise, if you do choose to keep the money as a loan, just note that it is still, from my interpretation, you are still required to use it on those eligible payroll or non-payroll costs. When you filled out the original application for the loan, it stated that you were only going to use those funds for the eligible costs. It did not identify that you could only use them for the eligible costs in the covered period. It stated that you were taking this loan out to cover eligible payroll and non-payroll costs. So it does not become a working capital loan after that 8-week covered period is over. I would make sure that you're still using it for any of those identified eligible costs. It does not just turn into a loan that you can use for any purpose. So with that, that was a lot of information, and I'm sure some of it was not as clear as, well, I hope it was as clear as it could be, but there is a lot of information. There's a lot of math, there's a lot to learn, and there's a lot of changes that are still out there. So we want to make sure that you have access to our resources. The AICPA, which is our guiding resource, the international, or not international, but our CPA organization, they did create a calculator that we've given you a link to on this resource center. The likelihood is we expect that the SBA will come out with a formal calculator once all of the rules are in place. So make sure to be on the lookout for that. Keep an eye on our website, and we'll certainly make that available once it's available to us. But just a reminder to continue watching the news, looking at these resources, because things are likely to continue changing. And we want to make sure that, everybody knows that what we talked through today is not what's going to be final. It is new guidance, and it's good guidance, and it gives you the chance to get an idea of what your forgiveness could look like. But it's important to note that we will likely still see some changes coming down the pipe. So with that, I know we've only got about 15 minutes left. So Melody, if there are questions that you think it's important for me to get to before we sign off today, if you want to fire those off.
There's a fair volume of questions that's still concerned about the payroll period, the 56 days, and what that counts for, and not yet understanding that you can pay after your 8-week period and that still counts. So can we go back over that again, or maybe if possible, pull up the Excel and lay out dates so that you can kind of see it if that would work?
Absolutely. So the idea with the eligible payroll costs are that you can cover 56 days worth of payroll. So if you have a weekly or a biweekly payroll, essentially, even if there wasn't an alternative period for you to choose from, you would still have 8 weeks worth of payroll or 4 payroll, 8 payrolls or 4 payrolls. The alternative period just allows you to track it a little bit better and it allows you to push the date off a little bit so that you can start the clock ticking at a little bit later date, not a substantially longer date, but in my example, you could potentially push the start date of that 8-week period out 10 days. The language in all of the guidance says incurred or paid, which was confusing even to us because incurred would typically mean a standard accrual-based practice, and paid would typically be indicative of a cash basis. So the fact that they were saying incurred or paid was a little bit confusing. What we had been guiding people to before was to be thinking about it on kind of a modified cash basis thought process, which I think still applies, even though you can choose your alternative period, which would then include thinking about it on your pay period dates as opposed to your paycheck dates. So if you choose just the standard covered period that's going to start the day that you get your funds dispersed into your account, you're really kind of looking at it as a paid and incurred date. So if you're, in the example that I gave before here, if your date the loan funds were received as 4/15, your covered period is automatically 4/15 through 6/10. So the way that you're going to have to look at this, because you're only paying twice a month, you're actually not going to see 4 paycheck dates hit in that 8-week period. You're likely only going to see 3 paycheck pay dates hit in that 8-week period because you're paying twice a month. For example, maybe you're paying on the 1st and the 15th of each month. So here you're going to be able to, well, that's probably a bad example, maybe the 16th and the 30th. It ends up being that you're going to have an issue with getting your full pay period in because it's more than 8 weeks. So the idea is that you're essentially taking 56 days worth of your payroll, regardless of whether you pick your just initial covered period or the alternative covered period. The idea that that you can use incurred costs really, I think, applies the most to things like the employer paid taxes. When you think about like state unemployment tax, typically you pay that 4 times a year. You're not paying that with each payroll. State unemployment tax is a quarterly filing that's done. So you are incurring costs throughout the year, throughout, each quarter, you're incurring state unemployment tax by employee, but you're not paying it until, likely 1 month after the quarter end. So there's a potential that you're not going to have any actual cash payments to the state unemployment tax authority in your covered period. However, you have incurred those costs. So those incurred costs based on the 8-week period are included, which is why it's going to be very important that you're in contact with your payroll processor if you do outsource payroll to be sure that you're able to pull a report for that 8-week period so that you can see what costs were incurred in that 8-week period, because that's what's going to be covered, not necessarily cash out of the bank. That's another reason why we encourage people to open up a separate bank account and to use that bank account like a clearing account. The biggest reason was that you weren't likely going to be able to tie each payment that came out of the account to a number on a report that was going to be part of your eligible costs. There were all these other costs built in that weren't, when you, if your gross payroll is $50,000, the amount that's coming out of your bank as net pay to pay your employees is maybe going to be $35,000. So how do you show documentation, or how do you move money to show that actually $50,000 is what I could use my PPP funds for, not the $35,000? So when you're thinking about these incurred costs, we're thinking about that in terms of what actually happened in that 8-week period, not necessarily what cash came out of the bank. Now with the non-payroll costs, so rent and utilities, you're looking at, again, an 8-week period, but you're going to justify the fact that you had essentially 2 months worth of utilities and 2 months worth of rent, because in that 8-week period, you should be able to pay for 2 months worth, or it's going to be what months you're covering. So in our covered period here, 4/15 through 6/10, because it's an 8-week period, the likelihood is it's going to be May's rent and June's rent that is going to be covered in this covered period, because you're going to incur, the whole month of May, and you're incurring 10 days of June, but also 15 days of April. So your June payment is essentially covering the other 4 weeks that's split between 2 months. You're paying for 2 months worth of utilities and 2 months worth of rent or mortgage interest payments. So you have to be thinking about it as incurred and or paid. You have to kind of be thinking about it in both ways. What else?
Thank you. A couple of people have the situation where they're going to spend 100% on payroll. Do they have to submit any other expenses, on the application then?
If you are able to use all of the funds for payroll and it's not covering any other expenses, then you don't need to submit any other expenses on the application.
Awesome. As you were explaining the payroll, the 56-day kept coming up again in the chat. Someone saying, so if I have 2 months, I have to prorate to 56 days. That's correct.
Yes. Yep. It's only covering 56 days worth of payroll, not 2 months.
And if your payroll date in the example we have up here, let's say you pay right on 4/15 when you get it, that pay date is not eligible.
If you choose the covered period, if the original covered period, it can be eligible, yes.
But not that paid out that was paid for the first part of April, correct?
I think that it can be if you're thinking about it on a modified cash basis.
The way I've understood the instructions and what I have seen makes it clear that you cannot go backwards on any of this. It has to start incurring the day of, which is why you can extend payment past the date of the 8 weeks.
I don't have a full answer, yes or no, for that. My understanding is a little bit different, but.
Well, and I know, as we've talked about, a number of this is subject to further interpretation, yeah. But so everybody knows, the original law clearly stated incurred and paid. It's only been some of the guidance and instructions that have confused the matter because the law made it clear that it was both.
Yeah.
What about employee reimbursements for internet or phone?
That's a great question, and that has not been clarified at this point in time. I would be hesitant to include it right now just because there isn't clear guidance that states that is eligible. If you are an entirely remote workforce and you're paying people for their phone and internet, I would say it may be likely that that is covered, but there is not clear guidance at this point. It states utilities for the business, business utilities. So does the employer reimburse for employees count? Unfortunately, I don't have a yes or no answer on that. Keep tracking it, and it may be, but we need more clarification on that.
What about the transportation piece? Is that for mileage and reimbursement for employees' travel?
Another great question that we don't have very clear clarification on yet. The only clarification that did come out as it relates to the transportation was only in the guidance for Schedule C employers, where they are they're paying for gas or they're paying mileage, but that guidance was specific to self-employed individuals and not for employers with employees. So I would be hesitant to rely only on that guidance. Again, that's an item that unfortunately we still need more clarification on. Again, continue to track, continue to document, because by June 30th, hopefully we should have something final that clarifies a few of these missing pieces. So just continue to track it and keep documentation, but you still have some time for us to learn if that is actually eligible or not.
There's a couple of questions about the interest. One is loan used for new equipment. Is the interest portion eligible? My concern with the way that question was written is, can you clarify again when the debt has to be in place?
Yep, so you had to have had any rent agreements or debt agreements in place as of February 15th of this year. So if it's brand new equipment that you just purchased, put into service May 1st, it is not eligible. You cannot use the PPP funds for it. But if it's something that was in place on 2/15 or before, it is eligible, yes.
And what about capitalized leases? Do we count only the interest portion, or is the whole payment rent? How do we account for that?
Sure. So I would think about it if you have it sitting as a liability on your balance sheet. So it's a capital lease. Typically, it's going to be sitting on your balance sheet as a liability. Only interest is included. If you're making actual rent payments, so you're going to want to look at your agreement. Are you making rent payments? Or are you making what would be considered a debt payment, a mortgage payment? If it's a debt or mortgage payment, it's only the interest that's included. If it's a true rental, then you can include the full amount of the lease payment.
I'm going to jump in quick. Everybody, we just have a couple minutes left and we're going to answer a few more questions, but please make sure that you're submitting your questions that we didn't get to today in that Q&A feature at the bottom. Those are the questions that we're going to be following up with. So again, if we didn't get to your questions today, we know that there's a lot of them and it's very confusing. Just make sure you get those in at the bottom. Back to you, Melody.
Another question that's come up, and I know you addressed this somewhat, but I'll read this one specifically. If a Schedule C sole proprietor had a net loss on 2019 Schedule C, but was given PP funds on 5/20, can they return the funds?
Yes, they can, and they probably should, because it's going to be difficult to justify the use of the funds, because some of the supporting documentation is going to be likely a tax return, and they're going to be looking to see that the tax return matches what you reported. And if you were a Schedule C business and you had no employees and you had a net loss, the guidance does clearly state that you are not eligible for a PPP loan. If you had employees, you were eligible to take out the PPP loan to the effect that you had the payroll costs. So you couldn't include an amount to pay yourself when calculating the loan amount, but you could include amounts paid to actual employees, W-2 employees. But if you did have a net loss, probably you would repay the loan, which you can do. There's no prepayment penalties, so you can just pay it back.
What if I'm hiring new workers in this period? How do they factor into the FTE?
So they're going to be included in the calculation, and you can use the PPP funds to pay for new employees. I don't think anybody's going to be upset if you're hiring in addition to what you already had. So there's really no factor besides the likelihood of your loan forgiveness being fully reduced is just going to go up.
And just to clarify, because this question came up frequently, even though I know you talked about it, when we're talking about the wage reduction, it's the hourly person, it's the hourly rate, not the hours they worked.
Correct. That's correct. And it's going to be a dollar for dollar reduction.
So when they ask the questions, if they worked 20 hours at $10 in the past, now they're working 10 hours, or I forgot what I said backwards there, the same pay rate, but 10 hours, the wage reduction doesn't apply, but the FTE might.
Correct. Yep. Exactly.
They're also asking, back to the point about the co-ops, can you go back to addressing how that's treated for employees that are owners in a co-op?
Sure. If you get a W-2, so if it doesn't matter what percentage owner you may be, if you get a W-2, if you're an owner of any business, whether it be a co-op or anything else, included as part of the calculations in the worksheet. So you aren't including your compensation in that compensation to owners section. That compensation to owners is only intended for those people, the owners that are not getting a paycheck, like an actual W-2 paycheck.
Awesome. Well, thank you both so much for answering all those questions. It looks like we have run out of time for today. We appreciate everybody so much for joining us and all the questions that you have submitted. We will do our very best to get those answered today and tomorrow. Ladies, do you have anything else to add for today?
There's still money out there. So if you're on the line and you haven't applied or thinking about it, there's still money there. So make sure that you're doing some homework and investing. But if you need it, there's still money out there. So go for it and apply.
Awesome. Thank you so much. And make sure to keep a look on our website for upcoming webinars as everything continues to change and we learn more about what's going on. So thank you again for joining us and have a wonderful rest of your day. Thanks, ladies.
Thank you.
Thank you.